Tax season is upon us once again. And I feel like for a lot of people, it's almost like Christmas because people are looking forward to receiving a free gift from the government called the refund. Well, if you want to get the biggest refund, stick around for this one because I'm going to show you how. Let's go. What is going on, family? It is your favorite uncle cousin here, getting ready to really show you how to maximize your tax refund, or at least show you how it's possible to get the biggest tax refund, all right? So understand that there is a lot to unpack here. So please note that I will not be going through the entire spectrum of how to get a refund. Just the more common ways to do so. Let's start with how many ways are there to get a refund? Well, as of this video, there are only 3 ways to get a refund. The first one is through your withholding, meaning if you have more taxes withheld than you needed to, you will get the difference back in a refund. And don't worry, I'll show you an example in a minute. The second and most common way is through what is called refundable credits. Refundable credits are the credits that not only reduce your tax liability to 0, but if there's any amount of the credit left, you can receive that as a refund. And again, don't worry, I'll give you an example of that in a minute. And the third and final way to get a refund is through a combination of them both. Meaning that if you had more withheld than you needed to and you qualify for some refundable credits, you're going to get all of that. Okay, so before we get into how to get a huge refund, I'll need to give you a quick lessons on how taxes work and how we arrive at a tax refund. So let's take a look at a tax return. For purposes of this video, I'm going to break the tax return up into 3 sections. And what happens in those 3 sections is what determines our refund. The first section is going to be the income section. This section is where we add up all the income that you received for the year, subtract any adjustments and deductions to arrive at what is known as our taxable income. So if you're taking notes, note that, because the taxable income is the starting point to all of this. The next section is the tax section. In this section, we'll determine how much tax we are responsible for paying based on our taxable income. So the line to pay attention to in this section is the total tax. And finally, we have the payment section. This is the section where we will total all of our withholding and refundable credits to compare to our total tax liability to see if we're going to get a refund. So now that we know the flow and how we arrive at a refund, let's go ahead and look at the 3 ways refunds are generated, starting with the withholding from the paycheck. When you get your W-2 at the end of the year, you'll see that there were multiple amounts taken as tax withheld. But the one you want to pay attention to is the amount in box 2, the federal income tax withheld, as that is the one that is going to be on the tax return. Let me show you. Let's say that you're a single, no dependents, and you made $100,000. Well, as you can see on the tax return, we're going to list it right here on line 1. And that is going to carry down to line 11 because we're not adding anything else to it. There's no adjustment. So 100,000 is the amount that you made and it was reported on your W-2. We're going to take the standard deduction, the $12,550, and we'll subtract that from the amount that was reported on your W-2. So as you can see, again, taking note, line 15 is our taxable income. That is the amount that we're going to be responsible for paying our taxes on. So what happens is we scroll down here to the next page, page 2 here, you'll see based on our taxable income, our tax is going to be $15,003. But on your withholding, when we looked at our W-2, box 2, it said that we had $17,000 withheld. That's the amount that's going to go right here on line 25A. So what happens is when we compare the amount that we had withheld to the amount that we owe in taxes, we see that, well, we overpaid. And the difference is going to come down here as a refund. And that's how it happens from your withholding. Okay, so the next way to get a refund is by qualifying for refundable credits. As I explained earlier, regular credits simply reduce your tax liability to zero, whereas refundable credits not only reduce your credit to zero, but if there's anything remaining, you'll get that portion as a refund. For example, let's say that you made $50,000 and you had a qualifying dependent that was 12 years old. As we can see, same scenario, we're going to report the $50,000 here from your wages on line 1. No other income is added to it, so that becomes your total income. There's no adjustment, so again, still your total income. But the standard deduction goes up because for head of household, which is what you qualify for with a dependent, is going to be $18,800. So when we subtract the $18,800 from the $50,000, your taxable income remains, or should I say goes down to $31,200. And based on that amount, the tax is going to be $3,457. But look here, because you have a qualifying dependent, you qualify for the child tax credit here on line 19. Now, the child tax credit is a non-refundable credit, but you can see because your tax, the $3,457, was more than your credit, all of the credit got used up. The remaining balance is what's called your total tax. Same sense. So, and then again, we're still going to do the same thing, right? Compare your total tax, the $457, to the amount that you had withheld from your W-2, which is the $500. And guess what? You still overpaid, so you'll get a refund of $43. So to illustrate the difference between a non-refundable credit and a refundable credit, let's look at another example using a lesser amount. Let's say that you made $30,000 and you still had a qualifying dependent that was age 12. Again, everything pretty much remains the same except for the amount that we're reporting. Instead of $50,000, we have $30,000. You still get the head of household standard deduction of $18,800. So when you subtract that from the $30,000, your taxable income becomes $11,200. And this is where things change. Based on taxable income of $11,200, the tax is only going to be $1,123. Well, remember, the child tax credit is worth up to $3,000. But because the tax was only $1,123, you're only allowed to take $1,123 of the child tax credit. That's why it in itself is considered non-refundable, because it's only going to reduce your tax to zero, as we can see down here on 24. But you're like, hey, wait a minute. The credit is worth $3,000. I only took $1,123. I have some remaining. Absolutely true. You had over $1,800 remaining. But what happens is, let me scroll down here. We're going to ignore that $500 for a second. The child tax credit transforms into what is called the additional child tax credit, right? It goes right here on line 28. And that is only available up into a max of $1,400 per qualifying child. So even though you had over $1,800 left from the child tax credit, you only get to take $1,400 of it for the additional child tax credit. So what happens, we take the $1,400 that is refundable, compare that to the amount that we had withheld, the $500, that means, well, we'll end up with a refund of $1,900. And that's the difference between the refundable versus non-refundable credits. All right, so now that we have a good idea of how this works, let's now talk about the refundable credits that are available for you to take. And as of this recording, there are 4 common refundable credits, and they are the additional child tax credit, the child and dependent care credit, the earned income credit, and the American Opportunity Credit. Okay, so the next question to answer is, what's required to qualify for these credits? And honestly speaking, there are a lot of things that you must do and be to qualify for these credits, and it all varies depending on your individual situation. So please make sure that you talk to a tax professional, not your friends, to make sure that you are good. But for purposes of this video, I'll share a couple of the main qualifications that you must have and the maximum amounts that you can receive. Let's start with the additional child tax credit. The additional child tax credit is the refundable portion of the child tax credit. And as of this video, it's worth up to $1,400 per qualifying child. Looking back at the previous example, the one we just saw, we note that we had a remaining balance of $1,877, but was only able to take $1,400 of it as a refundable credit. But to qualify for the additional child tax credit, you'll need to, 1, have lived in the U.S. for more than 6 months, have a qualifying dependent age 17 and under, make less than $200,000 if you are single, and less than $400,000 for us married folks. Next up is the child and dependent care credit. As of the recording of this video, it is currently worth up to $16,000, of which up to $8,000 is refundable as long as your income is below $125,000. That's what the fine print is that you see there. And to qualify for the child and dependent care credit, you will need to have lived in the U.S. all year, have a qualifying dependent under the age 12, have earned income up to a maximum of $438,000, and you cannot use the married filing separate filing status. Next up is the earned income credit. Technically, the IRS says the earned income tax credit. We know it as maybe the EIC, but this credit can be worth up to $6,728 depending on your situation. And to qualify for it, obviously, you must have earned income. Duh, right? That's why the asterisk is there. You must have a qualifying dependent age 18 and under, or they have to be between 19 and 23 and be a full-time student in order for them to qualify for the credit. Also, must be a U.S. citizen or resident alien all year. And that's not it, my good people. It goes on. To qualify, you also must have less than $10,000 in investment income, cannot file as married filing separately, and you have to make less than, then it says see a graph, because there's a graph, and let me show it to you. All right, so here is the graph, and what this graph is doing is really breaking down how, like I said, every situation is different. Everybody qualifies differently for the earned income credit. And this graph is kind of showing us how it is for those of us who are single, head of household, for those of us who are married filing jointly. It shows you for no children, 1 children, 2 children, or 3. And it also breaks down the actual phase outs. So for those who are single and head of household, well, if you're single with no children, you can make a maximum of $15,980 because after that, the credit is equal to zero. And that's how we're going to look at this chart right here. If you're single and you have one child, the credit will phase out to zero once you go over 42,158. One child, if you have two children, the credit will phase out at this amount. 3 or more, the credit will phase out to zero at this amount. And if you're married, the phase outs are a little bit higher, but you can see this is the maximum that you can earn when, as far as qualifying for that, because any dollar over this amount, you get zero credit. And next up on our list is the American Opportunity Credit. This is a credit for education purposes for those who are enrolled in college. This credit can be worth up to $2,500, of which 40% of that is refundable, so a max of $1,000. And to qualify for the American Opportunity Credit, you will need to, obviously, you must file Form 1040. It can be for either you or your dependent. So this one is not necessarily dependent upon a dependent. I don't know if there's a pun or not, but hey, it's there. And you must be enrolled in college at least half time. Now, half time is going to be defined by the college that you're in, all right? Also, here's a funny one. You cannot have been convicted of a drug felony, which is funny. They don't care about any other crimes as long as you are not convicted of a drug felony. I guess it's because drugs in college is so synonymous. And then you must have paid at least $4,000 of your own expenses. No financial aid. Financial aid does not qualify for the American Opportunity Credit. You have to have paid $4,000 of your own out-of-pocket expenses for school. All right? And you must make less than $180,000 for married filing joint and $90,000 for everybody else. And lastly, I guess, as always, you cannot file as married filing separately. IRS just don't like folks who are married but choose to file separately for some reason. So if you do that, you won't get this credit. Okay, so now that we know the most commonly used refundable credits, their amounts, and the maximum amount of income you can get to earn them, let's see how they all work together. But before we begin, again, please note these two things. There are a lot more considerations when it comes to each of those credits than I've displayed here. So make sure that you talk to a tax professional to make sure that you qualify for any of these credits. And 2, there are way too many scenarios for me to cover. So I'm just going to show you the ones where you get the maximum refund. And since those involve having qualifying children, I'll show you what it looks like when you have 1, 2, and 3 children over the age of 6. Also note that in order to get the maximum refund, we'll have to have 0 tax liability. So the income that I'm using will result in 0 tax. Let's go. All right, so here we are, scenario 1, where we have someone who is single with 1 dependent. For this scenario, they maxed out an income of $19,500. Their standard deduction, again, because they're head of household, is $18,800. So we're going to subtract that from the income to arrive at a taxable income of $700. And based on that, their tax is going to be $71. Okay? So remember, the child tax credit is a non-refundable. It only reduces the tax down to 0. So because the tax was $71, the child tax credit is also $71, leaving their total tax at 0. And this is where the fun happens. So now that they have 0 tax, because they have 1 dependent at the prime income range, they get the maximum earned income credit, which is valued at $3,618. They also max out for the additional child tax credit, the $1,400. And let's just say, for purposes of this video, they actually spent childcare, right? Because they had to have, somebody had to watch a dependent while they was at work. So let's say they spent the max, $8,000, because it's $8,000 per eligible child up to $16,000 max, right? So they maxed out at $8,000. You get 50% of that as a credit. So they got the $4,000, which leads to a possible maximum refund for somebody in this scenario of $9,018 based on the facts and circumstances here. Now let's look at for somebody who is single with two dependents. Same situation, right? Income $19,500, standard deduction $18,800, taxable income $700, tax $71, child tax credit also $71, giving us a zero tax. Now, because they have two dependents, things change. Note, earned income credit is now $5,980. Big number. The additional child tax credit doubled up. They had two dependents. So $1,400 times two, $2,800. Added up right there. And again, they still had to pay for child care for both. And just assuming in this scenario, they maxed out, they paid the $16,000, they get half of it as a credit. Boom, right there. Possible maximum refund, $16,780. Oh, you know what? I forgot about the American Opportunity Credit. Let's assume, right, if you want to, say they paid for college, they maxed out, they paid $4,000 out of pocket. Well, guess what? They can add another $1,000 onto that, right? Man, that would make it $17,000. So beautiful. And then a final scenario, somebody single with three dependents, all numbers are the same, right? 19,500, 18 taxable income tax, child tax credit, zero tax. And drum roll, please, because this is where it really gets good. The earned income credit maxes out at $6,728. And let me make a note here. This is only for three children. It only calculates up to three dependents. You can have 30 dependents. You're only going to get EIC for three. That's the max. So that's going to be the max number for the EIC. The additional child tax credit is $4,200, but here's a note on that one. Whereas the EIC taps out for three children, the additional child tax credit doesn't have a cap. So if you had 30 dependents on your tax return, you can get the additional child tax credit for those 30 children. Just saying. And again, they still tapped out on the dependent care benefits for the child care. They paid for it. Even though they have three children, it maxes out at $1,600. So the max of the 50% is $8,000, giving them a possible maximum refund of $18,928. And if they went to school, right, and they paid $4,000 out of pocket, they still would qualify for the American Opportunity Credit, giving them a maximum of $1,000. So that possibly could be $19,928. Wow. All right, family. So those are the circumstances and conditions that must be met in order to get the biggest refund possible. Have low income and lots of kids. Let me know in the comments if you fit in any one of them situations, or if you know somebody who does. And if you do, share this video with them just in case they need to know. And as always, if you found value in this video, make sure that you hit that subscribe button, give it a thumbs up, and hit the bell notification so you'll be alerted when I drop the next one, which will be soon. And until the next time, know that I love you, and I'll see you on the next one.
Perfect.